Join me as I dig deep into the bull market and challenge myself to spot the red flags you need to watch out for right now. A bull market is a period of sustained market growth, typically defined by rising stock prices and increasing investor confidence. It's a time when many investors feel like they are making money hand over fist, and it's easy to get caught up in the excitement. But, as we'll explore, it's crucial to be vigilant for red flags during these periods, because even in a bull market, things can turn sour quickly. Many investors make the mistake of assuming a bull market will continue indefinitely. They see their investments rising and think, why bother changing a winning strategy? But, history has shown us time and time again that complacency can be a recipe for disaster. When everyone becomes too comfortable, it's often a sign that the market is due for a correction. Another misconception is that a bull market means all investments are good investments. Not true. Just because the market is going up doesn't mean every stock or asset is a good buy. This kind of thinking can lead to investors taking on too much risk, or worse, investing in assets that are fundamentally flawed. It's essential to stay grounded and evaluate investments based on their merits, not just the current market trend. Complacency can creep in when investors start to feel like they're invincible, like they can do no wrong. But, the moment the market turns, those who've been complacent are often left scrambling to adjust. The trouble with complacency is that it can lead to poor decision-making. When investors feel like they're on a roll, they might start to ignore warning signs or overlook potential risks. And that's exactly when the market can turn on them. It's human nature to get caught up in the excitement of a bull market, but it's crucial to stay rational and keep a level head. Rising interest rates can be a major red flag in a bull market. When rates go up, it becomes more expensive to borrow money, which can slow down economic growth and hurt stocks. For example, during the 2008 financial crisis, rising interest rates contributed to the housing market bubble bursting. Another red flag is overvalued stocks. When stocks become too expensive relative to their earnings or other metrics, it can be a sign that the market is due for a correction. Excessive euphoria in the market is another warning sign. When investors become overly optimistic, it's often a sign that the market is nearing a peak. For instance, during the dot-com bubble, investors were ecstatic about the potential of internet-based companies, only to see the bubble burst when reality set in. It's essential to stay informed and gauge market sentiment to avoid getting caught up in the hype. One recent example that comes to mind is the 2020 market correction. Many investors ignored the warning signs, such as rising interest rates and overvalued stocks, and paid the price when the market suddenly dropped. The correction was swift and severe, leaving many investors scrambling to adjust their portfolios. This example highlights the importance of being proactive rather than reactive. To avoid getting caught off guard, it's essential to stay informed and adjust your strategy accordingly. By recognizing these red flags, you can take steps to protect your investments and stay ahead of the game. The key red flags to watch are rising interest rates, overvalued stocks, and excessive market euphoria. So, what do you think about the current market? Are you feeling bullish or bearish? Share your thoughts in the comments below. If you're looking for more insights on how to navigate market fluctuations, be sure to check out my previous video on investment strategies.